Welcome to the comprehensive May 2026 outlook for Indian equity markets. This report synthesizes the latest market data, analyst projections, and key catalysts as of the April 30th close. The current landscape is defined by Nifty 50 at 24,044 and Bank Nifty at 55,403, reflecting a market in a recovery consolidation zone. Starting with our macro snapshot, the India VIX stands at 19.71. This elevated level signals high uncertainty, advising caution in position sizing. Crude oil remains a high risk, trading above $100 per barrel, putting pressure on the Indian rupee and widening the current account deficit. Foreign institutional investors have seen a record exit of $20 billion year to date, marking the largest foreign equity exodus in Indian history. Conversely, domestic institutional investors have deployed 1.9 trillion rupees in April alone, showing strong domestic conviction and resilient SIP flows. The RBI repo rate stands near 6.0% with an easing path. 2 more 25 basis point cuts are projected if inflation remains controlled. GDP growth is stable at 6.5%, with Nifty FY27 EPS growth improving to approximately 17%. Looking at benchmarks, Nifty 50 has a May bull target of 25,300. Technicals show RSI near 53, placing it in a neutral zone. Bank Nifty is neutral to weak at 55,403. Private banks like HDFC and ICICI Bank are better placed than PSU peers. The Midcap 100 index has seen its best month since November 2020, gaining 13.2% in April 2026. Small caps surged 20.1% in April, but valuation risks are real. The price-to-book ratio is at 4.2 times, warranting caution. Nifty IT remains cautious, down 21% year-on-year. Investors are grappling with AI disruption fears and the rise of agentic AI models. However, the current valuation at 23.6 times creates a deep value argument as established firms move toward outcome-based pricing. The auto sector is mixed, down 11% from conflict highs. Rising input costs are squeezing margins, though EV penetration remains a tailwind. Nifty FMCG offers a defensive refuge. An above-normal monsoon forecast for 2026 is a major positive for rural demand recovery. In the banking sector, private banks are preferred. We're watching the RBI repo rate trajectory closely for a potential re-rating trigger. HDFC Bank's 30-year legacy and the structural strength of ICICI Bank place them well, despite the 2026 governance concerns. Nifty Defense is a structural bull, directly benefiting from geopolitical tensions and a significant push for indigenous manufacturing and R&D. The metal sector has emerged as a top performer, led by Hindalco's 66.7% year-to-date gains, supported by China reflation. The single biggest near-term binary risk is the India-Pakistan geopolitical situation. A fragile ceasefire holds as the Islamabad Accord is negotiated. We are also monitoring the Strait of Hormuz. Any closure could send crude above $110, a major macro negative for India. The RBI MPC policy meeting is a key event. Any dovish signal on inflation and growth will be a major tailwind for financials and real estate. The Q4 earnings season is ongoing. Market focus is on whether results confirm the projected 17% earnings growth for fiscal 27. Global eyes are on the US FOMC rate decision. A dovish signal could weaken the dollar and trigger a long-awaited reversal of FII outflows. Progress on the India-UK trade deal is a structural positive for pharma exporters and IT services, demonstrating India's role as a manufacturing hub. An upside trigger to watch is a Hormuz ceasefire leading to crude falling below $90, which would be the single biggest market catalyst. Conversely, the primary downside risk is a re-escalation of regional conflict, which could cause a sharp market sell-off and spike the VIX above 25. Our sentiment dashboard shows a stark contrast. FII sentiment is at 20 out of 100, while DII conviction remains very strong at 88. Valuation comfort is mixed, with Nifty at 21 times forward P/E. Global risk appetite is at 45 out of 100 as AI dominates. In conclusion, our stance is cautiously positive. The market remains range-bound with asymmetric upside if geopolitical risks abate in the near term. We recommend an overweight position in metals, defense, pharma, and select private banks, while remaining underweight on IT and PSU banks. For mid-caps and small-caps, we maintain a neutral stance after the April rally, trim speculative positions and focus strictly on quality earnings growth stories. The way forward depends on RBI rate cuts and the status of regional ceasefires. Stay disciplined and focused on long-term structural stories in May 2026. Let's deep dive into the macro indicators. The India VIX at 19.71 reflects the market's high sensitivity to the current geopolitical climate. The rupee is in a stable zone between 94.50 and 94.80, though importers are watching the dollar trajectory closely. With inflation easing, the path is clear for the RBI to target a 5% repo rate by March 2026, a pivotal move for broader consumption. Moving to benchmark indices, Nifty 50's recovery consolidation zone is anchored by support at 23,800. A decisive close above 24,400 is needed to revive bulls toward the May bull target of 25,300. For Bank Nifty, open interest data pins the max pain range between 54,000 and 57,500 with mildly bearish undertones. Our sectoral projections highlight significant divergence. Nifty IT has plunged 21%, hit hard by fears of AI-driven model shifts. However, a deal flow revival in the first quarter of fiscal 27 and US tech capex moderation could serve as the necessary recovery catalysts. In the auto sector, structural domestic demand is intersecting with supply chain shifts. EV penetration remains a strategic secular tailwind for the industry. FMCG and financials are key pillars. HUL results and broad-based recovery expectations for fiscal 27 are driving sentiment in consumption. A good monsoon historically lifts FMCG volumes by 6 to 8%. This, combined with income tax relief, is boosting disposable incomes. In the financial sector, private banks like HDFC and ICICI Bank remain the preferred choice despite significant foreign selling pressure in early 2026. The structural story remains strongest in defense and metals. Defense capex and a focus on indigenous manufacturing are multi-year growth drivers. Hindalco is the Nifty 50 champion, gaining 66.7%. China's reflation and domestic infrastructure spend continue to support demand. Key catalysts in May 2026 will define the next leg of the rally. The Islamabad Accord negotiations remain the most critical geopolitical risk. The fragility of the Strait of Hormuz is critical. A reopening would drop crude to the $80 range, providing a powerful catalyst for Indian equities. A dovish Fed signal would weaken the dollar, reversing the massive FII exodus and providing the liquidity needed for a broad market re-rating. Analyzing triggers versus risks, the upside targets are driven by RBI rate cuts and potentially resilient DII SIP flows exceeding 25,000 crore per month. Downside risks include sustained FII selling and INR depreciation below 94.50, which would force the RBI to pause rate cuts. A pivotal midpoint in India's political cycle arrives with state assembly elections in 4 key regions, serving as a high-stakes referendum on central popularity. Our final verdict incorporates a mixed sentiment. While FII sentiment is low, domestic conviction and RBI support provide a strong foundation for May. The Nifty 50 is navigating extreme jitteriness, with the India VIX hovering around 18.05 as markets weigh political sentiment against macro headwinds. A warning on small-cap and mid-cap valuations. At 4 times price to book, they are stretched compared to historical averages, warranting a selective approach. A 7.5% relief rally followed exit polls suggesting policy continuity and a potential historic shift in the West Bengal bastion. Large caps offer relative safety, focus on overweight sectors where earnings growth is most visible and geopolitical sensitivity is manageable. Crucially, India enters a 10-month election-free corridor until early 2027, a vital window for pushing through slow-moving structural reforms. Recapping our strategy, stay overweight on metals and defense. These sectors have strong structural tails and are leaders in the current market cycle. While elections provide a sentiment floor, the durability of any rally will be tested by the grim macro calculus of soaring oil prices and regional conflict. Maintain an underweight position in IT and PSU banks until clearer signs of recovery or RBI re-rating triggers emerge later this year. The key watch remains regional peace status. Any de-escalation will be the ultimate risk-on trigger for the entire Indian equity landscape. As we navigate May 2026, investor discipline and a focus on high-quality earnings growth will be the differentiating factors for success. In a global context where risk appetite is mixed, India remains a resilient manufacturing and growth hub, attracting steady domestic participation. To recap Nifty technicals, support at 23,800 and resistance at 24,400 are the levels to watch. Bank Nifty projections see a range of 54,000 to 57,000, with RBI rate cuts remaining the pivotal re-rating trigger. Our sectoral summary shows strong structural bulls in defense and metals, with a cautious eye on IT and a selective approach to banking. The way forward is through selective quality. Trim momentum plays in small caps and focus on the large cap structural growth stories of fiscal 27. This report is for informational purposes only and does not constitute investment advice. Please consult with a registered advisor before making decisions. This is Rahul Malhotra signing off. Stay tuned for further updates on the evolving landscape of Indian equity markets.